Guys, something interesting just happened in the silver market, and I want to walk you through it, because the numbers aren't adding up. I called several major dealers this week to check prices on physical silver. The spot price on the screen showed around $72, but when I asked about buying actual coins or bars, the premiums were massive. Some dealers quoted $59 to $20 over spot. Others said delivery times were 4 to 6 weeks, and a few simply said they were low on inventory. So here's the question. If the price is $72, why does it cost $90 to actually buy it? And why are delivery times stretching out? This is called a premium expansion. And it happens when there's a disconnect between paper markets and physical markets. Ladies and gentlemen, today we're going to analyze what's actually happening in the silver market. Not with conspiracy theories, not with panic, but with data, market mechanics, and historical context. Because whether you own silver, you're thinking about buying it, or you're just curious about commodity markets, this situation teaches us something important about how markets actually work. We'll look at three things. First, the data. What do supply and demand numbers actually show? Second, the mechanics. How do paper markets and physical markets interact? And third, the context. Has this happened before, and what can we learn from it? By the end of this video, you'll understand the real forces at play. Not hype, not fear, just market dynamics. So let's dive in. Because education is more valuable than panic, and understanding how markets work will serve you better than any hot take ever could. Let's begin with the data. Let's start with what we actually know. Supply side. Global silver production in 2024 was approximately 830 million ounces. That's according to the Silver Institute's preliminary data. About 75% comes from mining, and 25% comes from recycling. The top producers are Mexico, Peru, China, Australia, and Russia. Now, production has been relatively flat for the past few years. No major new mines have come online, and some existing mines are dealing with declining ore grades. This means supply is constrained but not collapsing. Demand side. Total demand in 2024 was estimated around 1.2 billion ounces. That creates a structural deficit of about 200 million ounces. Where does demand come from? Industrial use takes about 50%. Electronics, solar panels, medical equipment. Investment demand, coins, bars, ETFs, takes about 30%. Jewelry takes about 15%, and silverware and other uses take the remaining 5%. Here's what's interesting. Industrial demand has been growing steadily, especially from the solar industry. Solar panels use silver in their photovoltaic cells, and as solar adoption increases globally, this demand is relatively inelastic, meaning factories need silver regardless of price. The inventory. Question. Now let's talk about inventories. Comex, the main futures exchange in New York, reports their silver inventories publicly. As of late December 2024, they showed approximately 270 million ounces in registered vaults. That's actually up from earlier in the year. London vaults, managed by the LBMA, hold roughly 800 million ounces. Shanghai Gold Exchange inventories have fluctuated but remain substantial. So are the vaults empty? No. But here's the nuance. Not all that metal is available for immediate delivery. Some is already allocated to specific contracts. Some is held by ETFs, and some is simply stored there but not for sale. The premium puzzle. This brings us back to our original question. Why are premiums so high if inventories exist? Several factors. First, logistics and distribution bottlenecks. Mints and refineries can only produce so many coins and bars per month. When demand spikes, they can't instantly scale up production. It takes time to strike coins, package products, and distribute them. Second, regional imbalances. Silver might be available in London, but not easily accessible to a dealer in Texas. Shipping, insurance, and customs all add time and cost. Third, dealer risk management. When markets are volatile, dealers widen their spreads. They need to protect themselves against price swings between when they buy wholesale and sell retail. Fourth, actual demand increases. Investment demand for physical silver has been growing. Retail buyers, concerned about inflation or currency stability, have been purchasing more. This creates genuine pressure on the retail distribution network. The paper versus physical debate. Now, there's a theory that gets thrown around a lot, that paper markets suppress prices while physical markets reveal true prices. Here's the reality. Futures markets serve legitimate functions. They allow producers to hedge. They allow industrial users to lock in prices. They provide liquidity. But yes, futures markets can trade at different prices than physical markets. This is called basis. When physical premiums are high, the basis widens. Is this manipulation, or is it just market mechanics? Economists would say it's primarily the latter, but that doesn't mean markets are perfect. Historical context. This isn't the first time we've seen premium expansion. In March 2020, during COVID panic, silver premiums exploded to $8 to $10 over spot. In 2011, during the last silver rally to $49, premiums were also elevated. In both cases, premiums eventually normalized. Why? Because high premiums incentivize increased production of coins and bars. Mints ramp up, dealers stock up, and supply meets demand. What about China? Now, regarding export restrictions. China has indeed implemented various controls on strategic materials. This is documented policy. But a total ban on silver exports starting January 1st? I haven't found credible official sources confirming this specific claim. China does refine and consume a lot of silver domestically, and they are less transparent about their strategic reserves, but we need to be careful about unverified claims. The bottom line on data. The silver market is experiencing a structural deficit. Demand exceeds supply. This creates upward pressure on prices. Physical premiums are elevated due to distribution constraints and increased investment demand. But the market isn't broken, it's just tight, and tight markets tend to adjust over time. Let's talk about how these markets actually function, because understanding the mechanics helps us interpret what's happening. How futures markets work. Comex. Silver futures are contracts for future delivery. Each contract represents 5,000 ounces. Most contracts are settled in cash, not physical delivery. Why? Because most participants are hedgers or speculators, not industrial users. A mining company might sell futures to lock in prices. A manufacturer might buy futures to secure supply. And traders provide liquidity to both sides. Only about 1–2% of contracts result in actual physical delivery. This isn't a flaw, it's by design. Price discovery. Futures markets help establish global price benchmarks. The spot price you see quoted is derived from the most active futures contract. This price then influences physical markets worldwide. Dealers use it as a reference point and add premiums based on their costs and local supply demand. Why premiums vary. Think of the spot price as wholesale and physical prices as retail. Retail always includes markup for manufacturing. Has it happened? Rarely, and usually the market adjusts. Global flows. Silver moves around the world constantly, from mines to refineries, from refineries to fabricators, from fabricators to end users, and through various storage and trading hubs. London, New York, Shanghai, and Zurich are major trading centers. When one region experiences shortage, metal flows there if the price incentive is strong enough. This is called arbitrage, and it's how global markets balance. The role of ETFs. Silver ETFs like SLV hold physical silver in vaults. When investors buy ETF shares, the fund buys physical silver. When they sell, the fund can sell silver. This creates another connection between paper and physical markets. ETF holdings have been growing, which does remove silver from other potential uses. But it's not hidden or manipulated. ETF holdings are publicly reported. Central bank activity. Unlike gold, central banks don't typically hold large silver reserves. Silver isn't part of most countries' official reserves. So central bank buying, selling isn't a major factor in silver markets. This is different from gold, where central bank purchases can move markets. What about the reset? Theories? Some commentators predict an imminent monetary system reset, where commodity-backed currencies replace fiat currencies. Is this happening? The BRICS nations are indeed discussing alternative payment systems. This is documented. But a full commodity-backed currency system faces enormous practical challenges. How do you handle fluctuating commodity prices? How do you expand money supply as economies grow? These aren't trivial questions. Could it happen eventually? Perhaps some hybrid system could emerge, but expecting it on January 1st? That's speculation, not analysis. Informed skepticism. The key to understanding markets is informed skepticism. Don't dismiss everything as conspiracy, but don't accept everything at face value either. Look for verifiable data, understand the mechanics, and recognize that markets are complex systems with many moving parts. So what should you actually take away from this analysis? First, understand what you're buying. If you're considering silver as an investment, understand the difference between paper silver, ETFs, futures, which offers price exposure with high liquidity, physical silver, coins, bars, which offers tangible ownership but with premiums and storage considerations. Neither is inherently better. They serve different purposes. Second, premiums are part of the cost. If you buy physical silver, you will pay premiums. This is normal. Factor it into your investment thesis. And understand that when you sell, you might not recoup the full premium. This affects your break-even point. Third, diversification matters. No single asset is a perfect protection against all risks. Silver can be part of a diversified portfolio. But putting all your resources into one asset, any asset, increases risk. Balance is key. Fourth, time horizon matters. If you're buying physical silver, think long-term. Short-term price movements can be volatile. Premiums can make short-term trading unprofitable. But over longer periods, supply and demand fundamentals tend to matter more. Fifth, stay informed, not panicked. Markets go through cycles. Prices rise and fall. Premiums expand and contract. This is normal market behavior. Staying informed helps you make rational decisions. Panic leads to mistakes. What about current market conditions? The silver market is experiencing some tightness. This is real. Industrial demand is strong. Investment demand has increased. Supply is constrained. These factors support higher prices over time. But does this mean you must buy today or miss out forever? No. Markets create opportunities constantly. If premiums are too high for your comfort, you can wait. If you believe in silver long-term, you can dollar cost average over time. The key is making decisions based on your own financial situation and goals, not based on fear or hype. Final thoughts. The silver market is fascinating. It combines industrial use, investment demand, and monetary history. Understanding how it actually works is more valuable than any hot take. Whether prices go to $80, $100, or back to $60, understanding the fundamentals helps you navigate whatever happens. Education empowers you. Panic doesn't. So keep learning. Stay curious. Question narratives, including mine, and make decisions based on your own research and circumstances. If you found this analysis helpful, subscribe for more educational content on markets and economics. And remember, the best investment you can make is in your own financial education, because knowledge compounds forever. Thanks for watching.